Hello and welcome to the HK webinar on secondary listings on the Hong Kong IPO market. My name is Debbie Davison and I'm the co-founder and COO of HK Group. HK is the premium corporate service provider in Asia and has a presence in 7 jurisdictions, including Hong Kong, Singapore, Thailand, China, Vietnam, Malaysia, and Indonesia. Secondary listing is an increasingly popular trend in the Hong Kong stock market, particularly in the recent months. Investors have shown great enthusiasm in the secondary listing of NetEase and JD.com, with both listings accounting for about 63% of the total funds raised in Hong Kong by mid-June 2020. What motivates these Chinese companies to come home? And what do companies need to be aware of when contemplating a move or secondary listing into the Hong Kong capital markets? Today, we're very fortunate to have a panel of distinguished guests with us today who are experts in their fields, and they will provide us with invaluable insights on secondary listings and the Hong Kong IPO market in general. First up, we have Kenneth Ng, a Deputy General Manager with CMBC Capital. Kenneth has over 20 years of experience in the financial services industry and has built up a deep and collaborative relationship with financial regulators. He has led many innovative and high-profile projects throughout the years, including KissTech, Valipar Holdings, the Boldcom spin-off and listing, as well as the Huaitong Securities on the HKEX shares. Kenneth has also handled many large and complex M&A transactions over the years, including Baotai Aluminium, as well as the acquisition of the Hong Kong listed company, China Overseas Grand Ocean Group, by the China Overseas Land Investment Limited. Next, we have from PwC, Ivan and Tina. Ivan is a partner in the assurance department of PwC and has over 25 years of experience in auditing, listing, and business consulting. Ivan is familiar with the capital markets in Hong Kong as well as in Singapore and has led a number of high-profile IPO projects, including large fundraising and cross-border dual listing projects, such as Sands China or the HKT Trust. Tina is the Senior Manager in PwC's Hong Kong Capital Markets practice, specializing in Hong Kong IPOs and other capital markets transactions. The most recent IPO in which she was involved was the secondary listing of NetEase Incorporated. Next, we have Sammy Lee from Hogan Lovells. Sammy has a dedicated practice in the equity capital markets and general corporate transaction work, and is a well-recognized lawyer advising on the Hong Kong equity capital markets. His capital market practice includes IPO, global offering, rights issue, and other capital markets fundraising transactions. His most recent completed deals include the Hong Kong listing of Central China New Life, Tai Hing Group Holdings Limited, and Manpower Group Greater China. Finally, we have my partner, Gary Wong, a partner from HK. With over 16 years of experience in the financial and corporate services industry, Gary has completed numerous cross-border M&A in Greater China, as well as providing debt financing services to companies in Hong Kong, China, and London. Gary leads the client service team in HK Hong Kong in the provision of a wide range of services today, including family trust, corporate estate planning, as well as establishment and management of companies regionally. He also has experience in fund administration and accounting services. So now, Kenneth, as our first speaker, will give us a brief overview and forecast of the IPO market, the positioning of the Hong
Debbie, I can start now because you have just muted your voice. I think I can start now. Thanks, Debbie, for the opening introduction of this webinar. And the speakers today include myself, Sammy, Ivan, Tina. Yeah, everyone knows that this is Kenneth Ng from CNBC Capitals. Hi, everyone. CNBC Capital is a non-wholly owned subsidiary of China Minsheng Bank and is also a listed company in Hong Kong, engaging in investment banking, securities, and asset management businesses. I will explain to you why Hong Kong is a good place for secondary listing and its possible impact on the Hong Kong stock market. Before going into these two topics, let's have a quick review on the Hong Kong IPO in the first half of 2020 and a brief forecast for the second half. In the first half of 2020, the Hong Kong IPO market has remained strong amid the COVID-19 pandemic. Hong Kong Exchange rose to third place in the global IPO market, thanks to the large size secondary listings of two US listed Chinese tech firms, as mentioned by Debbie minutes ago. They are NetEase and Dingdong. As you may know, the first secondary listing in Hong Kong Exchange after the rule change is Alibaba, which was the largest IPO in the world in 2019. In my slide, you can see some statistics of Hong Kong IPOs in the first half of 2020. We can see that in terms of fundraising size, IPOs of TMT and healthcare companies account for more than 80% of total fundraising in the Hong Kong Exchange in the first half of 2020. In the second half of 2020, we expect that, can you move on to the next slide, please? We expect that the IPO activities of Chinese companies in the US will remain hindered by the pandemic, intense Sino-US relations, and policy headwinds in the remaining time of 2020. Regulatory reforms, the resilience of tech businesses, and abundant market liquidity flowing into Hong Kong are set to prompt listing of more new economy companies in the second half of 2020, making Hong Kong again the key listing venue for new economy companies. I think everyone has heard about the exciting news yesterday about the dual listing of Ant Group in Hong Kong and Shanghai stock exchanges. Against this background, the market expects that there will be about 130 new listings, raising about 160 billion to 220 billion Hong Kong dollar over the course of 2020, including at least a handful of secondary listing. Secondary listing of US listed Chinese tech businesses. You can expect Hong Kong will remain steady as one of the top 3 ranking global IPO markets. Overall speaking, strong performance is expected from life sciences, healthcare, biotech, and TMT listings in Hong Kong in the near future. Next, I will talk about why Hong Kong is a good place for secondary listing and what attracts Hong Kong listed attracts US listed Chinese companies to seek for secondary listing in Hong Kong Exchange. I've summarized 7 factors. Please move on to the next page. Thank you. The first one is Hong Kong is indeed a good venue for fundraising. Hong Kong Stock Exchange is an international stock exchange close to mainland China, where a lot of investors have good understandings of those US listed Chinese companies and are eager to invest in them. Therefore, US listed Chinese companies are willing to come back to Hong Kong for fundraising purpose and expanding their shareholder space, which may in the long run enhance their valuations and corporate images. Second, intense Sino-US relations. Proposed regulations and legislation in the US, as we all know, are squeezing Chinese companies, jeopardizing their access to the US markets. US listed companies are therefore looking to Hong Kong to hedge their bets and to diversify their risk. Third, malicious shorting by investors. I believe that malicious attacks launched by hedge funds have made some high-quality Chinese stocks a victim of stock price manipulations. This is also a push factor to push US-listed Chinese companies to come back to Hong Kong. Fourth, the fact that applicants seeking listing in Hong Kong can continue to use the US GAAP in their listing documents in Hong Kong is also an advantage. It can largely reduce issuers' workload of preparation of financial statement in Hong Kong or international accounting standards, which are usually required for Hong Kong primary listing. I'm sure Ivan and Tina will tell you more details in this respect later in this webinar. A fifth exemption from Hong Kong listing requirements. US listed Chinese companies who intend to seek secondary listing in Hong Kong can enjoy a number of automatic exemptions from compliance of a series of listing rules of the Stock Exchange of Hong Kong. Such exemptions apply for rules relating to listing applications and also apply for rules for listed issuers' continuing obligation after listing. Moreover, we can see from the previous 3 secondary listing cases, the issuers also apply for other specific waivers from strict compliance of certain listing rules of Hong Kong Stock Exchange. Sixth, confidentiality is also a factor to be considered by secondary listing applicants. Overseas listed issuers can submit their listing applications in a confidential manner. It means that they don't need to post their draft prospectuses on Hong Kong Exchange website when they file their listing applications. And the public will only know their secondary listing after listing approvals are obtained and final prospectuses are published. Lastly, secondary listing can increase trading volume and liquidity. The trading of US and Hong Kong stock exchanges are in different time zones. If a US listed company also lists its shares in Hong Kong Stock Exchange, it can facilitate the trading of the shares of different investors located in different areas. In particular, I think it can enable Chinese investors to trade the shares more easily if they can be listed in Hong Kong. It can therefore increase the shares' overall trading volume and liquidity. Finally, we will discuss about the possible impact of secondary listing on the Hong Kong stock market. We expect that more secondary listings are coming. The market expects that there will be about 5 to 8 US listed Chinese companies returning to Hong Kong for secondary listing in the second half of 2020. They may include Baidu, Pinduoduo, Bilibili, Weibo, etc. You can refer to the end of my slide for the full list of potential US listed Chinese companies which may seek for secondary listing in Hong Kong. We also expect that companies with weighted voting rights, so-called WVR, and secondary listed companies may be included in the Hang Seng Index in the future, which will also induce more companies to seek secondary listing in Hong Kong. I understand Sammy will go through with you more on WVR later in this webinar. Secondly, we expect increase of southbound capital inflow. Hong Kong stock market welcomes the return of high-quality Chinese stocks, mainly because Hong Kong lacks enough new economy companies. And some Asia funds also hope to allocate their investments to other high-quality assets through Hong Kong Stock Connect mechanism. Secondary listing in Hong Kong enable mainland Chinese investors who cannot invest in Chinese companies listed in the US to buy their secondary listed shares in Hong Kong through the Stock Connect channel. It is expected that these stocks will be included in the eligible list of stock under Stock Connect scheme, which will surely attract investment from domestic institutional investors in China. We also expect secondary listing can increase overall valuations, quality, and diversity of Chinese stocks in Hong Kong. Since most high-quality Chinese stocks belong to high technology and new economy companies, the return of Chinese stocks to Hong Kong Stock Exchange will not only improve the overall quality and diversity of stock market in Hong Kong, but will also increase its overall valuations. Pleasant. For example, Hang Seng's index price earning ratio is in the range of 10 to 12, which is roughly equivalent to the position of in 2008 and early 2016. I expect that if, for example, Alibaba is included in the Hang Seng index, it will have a very positive impact on the index PE ratio. Next, I also believe it will help increase investors' confidence in Chinese stocks. Listing in both US and Hong Kong means that listed issuers are able to comply with two sets of stringent listing rules and regulations, and listed issuers will be supervised under two regulatory bodies in the US and Hong Kong at the same time. Investors will therefore have high confidence in Chinese companies with secondary listing status in Hong Kong, which in return may somehow also increase investors' confidence in other high-quality Chinese companies with primary listing status in Hong Kong. Finally, we expect increase in overall market liquidity. As mentioned in my point 2 above, there will be an increase in southbound capitals inflows to Hong Kong stock market. Such capitals will be initially invested in Chinese companies returning from the US market. However, after the related investments are realized, such capitals may stay in Hong Kong and be allocated to invest in other high-quality stocks on the stock exchange. Therefore, I believe it helps improve the overall market liquidity of all stocks listed on the Hong Kong Stock Exchange. Next page, please. Concluding my part of this webinar, I've prepared a list of US-listed Chinese companies with potential to seek secondary listing on the Stock Exchange of Hong Kong for your information. You can ask Debbie to obtain the list if you wish. Now, I'll pass the time to Ivan, Tina, and Samuel, who will further introduce the secondary listings in Hong Kong, more from accounting and listing rules perspective. Thank you. Thank you, everyone.
Thank you, Kenneth. Good afternoon, everyone. First of all, thank you, our client, having us to present to all of you the secondary listing and the Hong Kong IPO market. In the next 10 minutes, what we are going to do is to give more details as to what the listing rules requirements are for the secondary listing in Hong Kong. But by all means, if you have questions relating to listing in Hong Kong, you can also ask in the Q&A session. And then what we'll do is we'll also share some critical factors for the successful secondary listing, as we were involved in all the 3 secondary listings so far in Hong Kong. So feel free to raise any questions. So now I'll pass on to Tina to go through with you the detailed listing rules requirements for secondary listing.
Hi everyone, I'm Tina and I'm a senior manager from the Capital Market Services Group in PwC. And in our sharing today, we will cover 3 main topics, including comparison of the requirements of overseas listed companies. Secondly, on the key financial deliverables for secondary listing. And lastly, as mentioned by Ivan earlier, critical factors for secondary listing. So in this slide, they're showing 3 different routes for overseas listed companies to return to the Hong Kong capital market. Firstly, they can do a privatization and followed by a listing on the Hong Kong Stock Exchange. Secondly, a dual primary listing, which means that they can maintain their listing status on both exchanges, but meaning that they will also need to comply with the requirements in both stock exchange. And thirdly is the secondary listing, which will be covered in the slides. Next slide, please. This slide gives a snapshot of the key listing requirements of the 3 different routes. In terms of applicability, the first 2 routes are generally applicable to all sorts of companies across different industries. Secondary listings can be done through Chapter 19 or Chapter 19C. However, it's worth to note that companies based in Greater China could not secondary list in Hong Kong under Chapter 19. It is in 2018 that the HKEX introduced a new concessionary route under Chapter 19C, which allows companies involved in innovations, with at least 2 years of listing status on the New York Stock Exchange, NASDAQ, or the London Stock Exchange to consider to secondary list in Hong Kong. In terms of the track record and market capitalization requirements, the requirements are the same for the first two routes and the secondary listing under Chapter 19. Whereas for Chapter 19C, a 3-year track record period is required, and as for market capitalization requirements, they need to have a market capitalization of at least 40 billion at the time of listing. Or they need to have a revenue of at least 1 billion in the most recent financial year and a market cap of at least 10 billion at the time of listing. Next slide, please. In terms of listing rule compliance, privatizations and privatization to list and dual primary listing will have to fully comply with the Hong Kong listing rules. For secondary listings, extensive waivers from listing rule compliance will be available. However, it's also worth to note that for Chapter 19 secondary listings, there will be certain requirements that would need to be fulfilled for the exchange consideration of further waivers. For example, the market capitalization needs to be in excess of $400 million. They need to be primarily listed for at least 5 years on one of the recognized exchanges and demonstrate good compliance record. In terms of financial statements compilation, financial statements can be prepared in accordance with Hong Kong FRS or IFRS. For dual primary listed issuers, if they decide to use other financial reporting standards which were adopted in their original stock exchange, a reconciliation to IFRS or HKFRS will need to be presented in the accountant's report as well as in future interim and annual reports. Whereas for secondary listings, US GAAP is allowed and there's no reconciliation needed. All in all, in analyzing the different types of routes, for privatization to list, it involves high costs in the listings, and there's also more, it also may take time for sourcing funds to buy back the shares. For dual primary listing, listing status can be maintained, but again, there will be more stringent requirements to fulfill. For secondary listings, it is more efficient and there are extensive waivers available. As well, it has reasonably cost and had a manageable listing timetable. The recently secondary listed companies, including Baba, Netis, and JD.com, are all listed under Chapter 19C. Thank you. Next slide, please. Okay, in the following next 2 slides, I'm going to cover some typical financial related waivers available for secondary listed issuers. The Hong Kong listing requirements for connected transactions and notifiable transactions are automatically waived for secondary listed issuers. This means that the secondary listed issuers will only need to comply with their original primary exchange requirements with respect to these transactions. There are also other typical financial waivers granted by HKEX relating to certain disclosures in the accountant's report or prospectus. For example, relating to the aging analysis of AR, AP, the company level balance sheet, directors' emoluments, and 5 highest paid individuals. Those are commonly waived for a secondary listed issuer. Next slide, please. And this is a very important waiver, especially for companies which has plans for or they have acquisitions as part of their normal course of business. Under the Hong Kong listing rule, for listing applicants with acquisitions after track record periods, the pre-acquisition financial information of this target will actually need to be audited and disclosed in the accountant's report. In the recent market cases, we noted that exchange has actually granted a waivers to the secondary listed issuers who had this type of acquisitions after the track record period, which are immaterial. And next slide, please. In this session, I shall cover the key financial deliverables for a secondary listing. So first of all is the accountant's report, which is a very important document in the listing document, setting out the financial information of the listing applicant, there are three main points that I would like to share. First one is that the last audited balance sheet date of the accountant's report should not be more than 6 months from the date of prospectus. And if an additional stub period will be needed under such situation. And the second point is very relevant for companies listed overseas. If you publish a more recent interim financial information in your other stock exchange, such financial information will need to be included in the Hong Kong prospectus and reviewed by the reporting accountant. As for the last point, it is relating to companies which had adopted certain new accounting standards during the track record period, and if they have adopted these standards using modified method or prospective method, which are allowed under the relevant accounting standards, the exchange is usually fine to use this same set of method in the accountant's report, and there's no need to retrospectively restate the previous, retrospectively apply the methods under retrospective method in the financial statements. And then on the second part is pro forma financial information, which basically depicts the picture of the listing applicants, assuming that the completion of the global offering had taken place. And on the last point is about the retrieval of regulatory filings. These are especially applicable to companies which had entities in a PRC. As part of the sponsor's due diligence, they will retrieve the regulatory filings, and the company will need to prepare a reconciliation between this retrieve the regulatory filings to the accountant's report. And the reconciliation relating to the nature of these differences will need to be explained and submitted to the exchange on a private basis. And next slide, please.
So now, thank you, Tina. I think after going through the detailed listing rules requirements for both the dual listing and the secondary listing, I have here summarized the key critical factors that we have noted in the 3 secondary listings recently happening in Hong Kong. Firstly, as I think our experience is that the Hong Kong Exchange has taken a pragmatic and relatively flexible approach in vetting the secondary listing applications in Hong Kong under Chapter 19C. Basically, I think what the potential applicants may need to focus is try to understand the definition of innovative company and how you can qualify for your company to be under that definition. So a couple of factors you may need to consider, like the new technologies your company has deployed recently, the innovations and the business models. Another quantitative factors that you may start gathering the information is how much R&D expenses have you been incurring in the past years to demonstrate that you are qualified as an innovative company within the 19C definition. And then the next few points are something that you actually should have monitored quite closely is in your current primary exchange that you are listed, the applicants may need to ensure that they have kept a good compliance record for all the listing rules, requirements, and disclosure in the current exchange. And the next point is about the overseas stock exchange that would qualify for 19C. The exchange actually has set out a few recognized stock exchange that would qualify for the 19C. They are the exchange that Tina mentioned, like the NASDAQ, the NYSE, and so on and so forth. That one you can check with the listing rules. And lastly is when you are preparing for the listing, you may check with your professional, like the lawyers and the accountants, what type of waivers you expect to seek in the application, so that you won't be surprised by additional disclosure requirements later on. So I think that ends our presentation, and we are happy to take any questions in the Q&A session. Thank you. And over to you, Sammy.
Thank you. Thank you very much, Ivan and Tina, and then also Kenneth. Can you guys hear me? Because I can't quite tell whether you guys can hear me. Are we good? Hello?
Sammy, we can hear you fine. Thank you.
Yeah, you can hear me. Okay, good. Right, so thank you very much, Debbie, Kenneth, Ivan, Tina, for a very detailed summary of what some of the rules are seeking a secondary listing for innovative companies in Hong Kong. Some of my slides actually overlap with what Kenneth and Ivan and Tina have already covered, and so if there's a duplication, please bear with me. Tina mentioned secondary listing is nothing new in Hong Kong. We have had secondary listings for a long while. Chapter 19 was specifically 19.29 had been around for 10, 20 years. We've seen very successful secondary listings like Manulife. About 10 years ago, there was a wave of secondary listings involving Hong Kong depository receipts, companies like Valet, Fast Retailing. This time round, the exchange is introducing secondary listings again for the third time, I guess, and the purpose of it is to attract innovative companies, the unicorns of this world, which are already listed in an overseas jurisdiction, to come back to Hong Kong. Partially, this is driven by needs, because a lot of PRC investors would prefer investing through the Hong Kong system. But also, I guess, for the reasons that Kenneth mentioned earlier on, there may be disadvantages having simply a listing in the US for these companies. As such, the exchange introduced in 2018 some changes to the current existing, then current listing requirements. These introductions allowed basically innovative issuers which are primarily listed on qualifying exchanges. The most important one is issuers with the center of gravity in Greater China now are permitted. Previously, under the old rules, if your center of gravity is considered to be in the Greater China region, then you should not be seeking secondary listing in Hong Kong. And finally, those which have weighted voting rights arrangements, and this is particularly prominent in tech companies and new economy companies. So these companies can now list in Hong Kong. And those companies which have weighted voting rights arrangements, they can both primarily list or secondary. Oh, can I have the next slide, please? Thank you. So I mentioned just now the changes made possible what wasn't possible before. Previously, companies with a center of gravity in Greater China, that's not allowed. If you have weighted voting rights, that's not allowed. And also the historical position for the Hong Kong Stock Exchange is they want all shareholders to be equal. They insisted on the one share, one vote arrangement, which is why weighted voting rights are not permitted. Can we move on to the next slide, please? This slide very much repeats what I have spoken about already. Just very quickly, 19C is aimed at attracting high growth tech companies. It's worth noting 19C is not intended to cover biotech companies. At the same time of the introduction of 19C, the Hong Kong Stock Exchange also introduced a new chapter which specifically targeted at biotech companies being listed in Hong Kong. In that chapter, biotech companies also have a lot of special arrangements which allow them to and make them attractive to come to list in Hong Kong. The listing jurisdiction of these qualified issuers is important. The exchange only allow those that are listed on the NYSE, NASDAQ, or the premium segment of the London Stock Exchange, the main market, to benefit from Chapter 19C. Now, Chapter 18A is another newly introduced chapter which allows companies with weighted voting right structures. Worth noting, this chapter is not exclusively applicable to companies seeking secondary listing. This chapter is applicable to other companies who are seeking primary listing as well. And as Tina has mentioned already, the new rules allow qualified issuers to dispense with certain requirements which are otherwise required and are applicable to companies seeking primary listings in Hong Kong. Next slide, please. Alibaba is a good example. Again, this has already been covered by Kenneth and the PwC team. This was the first. Successful one. Since then, we had NetEase and JD.com. Next, please. Again, this slide has already been adequately covered by Kenneth. I won't spend too much time on it. It does bring Hong Kong. It makes Hong Kong a more attractive jurisdiction for investors, especially PRC investors. Next, please. So more of the legal stuff. There are 4 bullet points on this page. The first one is the joint policy statement regarding the listing of overseas companies. This policy was introduced about 20 years ago. It's been updated a number of times, and it's through this joint policy statement where the idea of allowing secondary listing was made possible. As I said, since then it's been upgraded a few times, and it allows secondary listing, and it allows companies incorporated in a vast number of different jurisdictions to get listed in Hong Kong, and over and above the typical ones like Bermuda, Hong Kong, or Cayman Island. Chapter 8A, I mentioned just now, this is new, allow weighted voting rights arrangements to exist in companies to be listed in Hong Kong, and 19C is secondary listing of innovative PRC companies. A lot of the nitty-gritty of what's allowed, who is allowed, are contained in GL 9418, which was brought out pretty much the same time as the introduction of Chapter 19C. Next slide, please. This is a slide. The next slide is a list of all the a diverse list of jurisdictions for the incorporation of companies. Those companies which are not incorporated in the jurisdictions listed in this list may still consider. You just need to make additional application to the Hong Kong Stock Exchange and the SFC to get that particular jurisdiction approved and signed off. Next slide. Yes, some useful terminology that helps understanding who can and who can't benefit from the new chapters. Qualifying issuer is basically anybody listed on a qualified exchange. A qualifying exchange, as mentioned before, NYSE, NASDAQ, and the main market of the London Stock Exchange. The chapter differentiates Greater China issuer and non-Greater China issuer. This is relevant because issuers which had a center of gravity in Greater China would not have been allowed under the old regime. Under the new regime, they can. Center of gravity in China, there are a number of specific factors, non-exhaustive factors, which the stock exchange will consider when they consider whether an issuer has its center of gravity in Greater China. For example, whether they already have listing in Greater China, whether where the place of incorporation, the history, where their headquarters is, where their main business operations and assets are, where they pay the taxes, where their management are based. So a bunch of these, but I would say it's probably quite obvious when you see it. You should be able to tell whether an issuer has a center of gravity in Greater China. Apart from splitting up the qualified issuers into Greater China issuer and non-Greater China issuer. The definitions in Chapter 19C also differentiates grandfathered and non-grandfathered Greater China issuers. And the all-important date is 15th December 2017. So if you are a company already primarily listed elsewhere on or before 15th December 2017, you are considered to be a grandfathered Greater China issuer. If you only became listed after that date, 15th December 2017, then you are non-grandfathered. The relevance of whether one is grandfathered or non-grandfathered determines how much flexibility the exchange will be giving you under these new chapters. And then innovative obviously is a very key word. And let's move on to the next few slides where we'll go through what would be considered as innovative and what not. Now, an important concept is a qualifying issuer must be both eligible and suitable. Now, eligibility and suitability, these are relatively well-trodden and well-defined terminologies for those of us who work on listings and IPOs day in, day out. Now, innovative companies, if we move on to the next slide, please. Innovative companies under Chapter 19C and also as stated in the guidance letter is likely to be considered by the Hong Kong Stock Exchange to be suitable. Now, to be considered as an innovative company, the exchange has spelled out a number of characteristics, and you're expected to have 2 or more if you were to be considered as an innovative company. First of all, your success needs to have been attributable to the application of new technologies, innovations, and or new business model to your core business, which differentiates yourself from other existing players in your industry. To be innovative, you need to have your own R&D, and that R&D needs to have significantly contributed to your value or will contribute to your expected value. And also, the outcome of the R&D is going to comprise a major activity of your company going forward. You need to have unique features or intellectual property. And most importantly, as we've seen, it needs to have an outsized market capitalization or intangible asset value relative to its tangible asset value, an asset light, a relatively asset light company, essentially. It's worth noting the Hong Kong Stock Exchange has sole discretion to determine whether an issuer is sufficiently innovative, and potential applicants should reach out to the Hong Kong Stock Exchange at the earliest instance as part of the pre-A1 submission to make sure that they satisfy this, they fall within the ambit of this this word innovative. And also worth noting that what is innovative today may not be innovative tomorrow. If you are, the first innovative business in a particular industry, then yes, you might be suitable for a Hong Kong listing. But if over time your novelty, your innovativeness may no longer be innovative, and that may disqualify you relying on this on this route to list in Hong Kong. And finally, the superficial application of new technology to an otherwise conventional business will not satisfy the suitability criteria. In other words, the Hong Kong Stock Exchange will look at the substance of what your technology is, and not just accepting any submission that says, well, we do have technology. When it's obvious it's really a conventional business. Next slide, please. Now, the new chapters is important is because up until the new chapters were introduced, the Hong Kong Stock Exchange had a long-standing principle, one share, one vote principle. And that one share, one vote principle basically disqualified a lot of companies which especially the innovative companies, the tech companies, which have weighted voting right arrangements stated in their constitution document. The introduction of Chapter 8A now allows these companies to come and list. Another feature which is common amongst tech companies, especially those in China, is they have what we call VIE structures. Now, prior to 19A being introduced, the exchange already have a set of requirements set out in one of their guidance letters, stating, issuers with VIE structures will need to meet certain disclosure requirements, or they may need to make amendments to their constitution documents. The new chapter allowing secondary listing of innovative companies provide for certain innovative companies to be able to get around that. Next slide, please. And this is the importance of grandfathered and non-grandfathered Chinese Greater China companies. I mentioned the key date is 15th December 2017. Can we move on to the next slide, please? So if you're a grandfathered Greater China issuer, then you're lucky. You have significantly fewer listing requirements to meet. The appendices 3 and 13 do not apply. You are not obliged to amend your constitution documents to meet the Hong Kong's key shareholder protection standards. You may be some automatic waivers will be available to you, and you can list, and this is quite important, you can list with your existing VIE structure in place and will not be required to demonstrate your ability to comply with the Chinese foreign investment law. Now, as a footnote on this slide, I have included a few bullet points which basically sets out what the current requirements are expected by the Hong Kong Stock Exchange for issuers with a VIE structure to be in place. And if you're a grandfather Great China issuer, then you don't need to meet these. Next slide, please. Another feature which if you're a grandfather Greater China issuer, which you will be able to benefit from, is in relation to your weighted voting right structures. So you can secondary list with your current existing weighted voting right structures in place and do not need to change your constitution documents in order to comply with other what other issuers what other issuers may otherwise need to satisfy, as set out in rules 8A 0.7 to 8A36, 8A43, and 8A44. Essentially, these rules require non-weighted voting right shareholders to be entitled to cast at least 10% of votes at general meetings. They require, there's a restriction in the ratio of voting rights attached to the weighted voting right shares compared to the non-weighted voting right shares to 10:1. And it would require the weighted voting rights arrangement to cease on a transfer of the beneficial ownership of the shares carrying weighted voting rights on the death of the beneficial owner or the beneficial owner ceasing to be a director of the issuer. So if you're a grandfathered Greater China issuer, you don't need to, you can get away from changing your arrangements. Next slide, please. However, the Hong Kong listing rules also set out a series of other items that if you're a grandfathered Greater China issuer, you need to satisfy. I won't read through each of them one by one. Suffice to say that these are slightly relaxed, actually quite a lot more relaxed than what would be otherwise required by non-grandfather Greater China issuers. Next slide, please. So, however, if you're a non-grandfather Greater China issuer, in other words, you only became listed on a foreign stock exchange much more recently, then you need to satisfy a lot more. The rationale of this differentiation by the Hong Kong Stock Exchange is to ensure that no one could get away with what they expect, i.e. these more stringent requirements, simply by first seeking a primary listing elsewhere. Now, for non-grandfathered Greater China issuers, Appendices 3 and 13 apply. So this basically brings it, makes it equal with basically all other listing applicants in Hong Kong. You will need to go through your constitution documents and change it such that it meets with the key shareholder protection standards. You will not be able to benefit from the concessions which the exchange make available to the grandfathered counterparts in relation to contractual arrangements and where the voting rights structured. And you'll need to meet with the much more stringent disclosure requirements regarding the VIE arrangement. And you'll need to provide to the exchange a legal opinion in respect of your VIE arrangement that they comply with Garci laws, rules, and regulations. And I think the final bullet point kind of repeats with what's spelled out above, so that we can skip the last bullet point. Next slide, please. Two final items that I want to touch on. Firstly, waivers and exceptions. As a secondary listing applicants, you will be entitled to a lot of waivers against what would be required otherwise by primary listed issuers. Tina already mentioned that there is a waiver, an automatic waiver in respect of all provisions relating to connect transactions, notable transactions, and the corporate governance code. In addition, depending on the issuer, one may make application to the exchange to seek further waivers. And we have seen in Alibaba, NetEase, and JD.com that these are usually granted, and exchange, like Tina said, takes quite a pragmatic approach to granting these waivers. So for instance, well, the first one is actually one that's relates to takeovers code. The exchange and the SFC will not consider these secondary listed companies as public companies, and therefore the public companies in Hong Kong, and therefore the takeovers code will not apply. Obviously the exchange and SFC will need to first consider a number of items, but most of these items will be able to be met by these unicorn companies which are already listed elsewhere. For instance, number of public shareholders, and the extent of share trade in Hong Kong, the size of company got to be huge, relative proportion of shareholders, and share trading activity in Hong Kong. The center of gravity test also appears here, and the general principle is the closer proximity of the management and business to Hong Kong, the more likely the code should apply. Next slide, please. This slide this is just a screen capture of all the secondary listed companies in Hong Kong now, to which the takeovers code do not apply. Next slide, please. Other waivers. Again, I think Tina has touched on most of them. Just very quickly flip through them. If you're a qualified issuer, then likely you'll be waived against disclosing interest under Part 15. Disclosure of interest information, prospectus disclosure requirements relating to investment acquisitions after TRP, accounts report disclosures, directors and 5 highest individuals, emoluments, options. Alibaba was the first one which got a waiver against printed prospectuses being dispatched at the time of the IPO. Further waivers include requirements to do monthly returns, subscription of shares by existing shareholders, and the 3-year restrictions on spin-offs. However, one item which cannot be waived is the requirement for compliance advisor post-listing. Next slide, please. This is just a very quick note to say the general principle for these companies seeking waivers would be the fact that there are already in existence commensurate disclosure obligations shareholders protection standards and overseas regulatory oversight in their primary listing jurisdiction, and therefore they should not be subject to basically a double obligation in these respects. Next slide, please. And finally, it's worth pointing out that, yes, you can seek a secondary listing in Hong Kong with relatively relaxed requirements. However, should you become an issuer which should be subject to primary listing restrictions, then the exchange has a mechanism in place to make you meet the primary listing requirements. Now, this all depends on where the majority of trading takes place. So when the majority of trading of your shares migrate to Hong Kong on a permanent basis, then you will be regarded as a dual primary listing issuer in Hong Kong and not a secondary listing candidate in Hong Kong anymore. And as a result, you will not be able to enjoy the benefit of the exceptions set out in Chapter 19C. Now, majority of trading moves to Hong Kong on a permanent basis means when over 55% of your total worldwide trading volume in dollars during your most recent financial year took place on the Hong Kong Stock Exchange. So 55% is the key percentage to consider. And if you triggered that 55% threshold, the exchange will give you a 12-month grace period. We can go back to this. Yeah, the exchange will give you a 12-month grace period to re-comply with the relevant listing rules. And that grace period will end basically 1 year from the date of exchange's written decision in that respect. Now, and when that migration happens, the following will happen. If you were an issuer that relied on the relaxation regarding the IE structure, you then need to comply with the more narrowly tailored requirements that all other candidates need to meet. Your constitution documents will need to be amended. A lot of the compliance obligations will come back in and bite you. And a number of waivers which were initially granted to you, for instance, those in relation to corporate governance, share report schemes, directors blackout and spin-offs, all these will be gone. You need to you need to take steps to meet them. And also the code, the takeovers code, will then become applicable. And finally, the waiver against disclosure of interest will no longer be available to you. So changing from a secondary listing status to a primary listing status will result in a lot of additional obligations and expenses. And so this is something which secondary listed issuer should bear in mind. Okay, this brings me to the end of my talk. Sorry, I probably overran a bit.
That's okay. Thank you, Sammy. I think Kenneth has to go. Thank you, Kenneth, for staying with us, and we will send you any comments, questions that people have, particularly for you. But thank you for joining. And then last we have, if anyone also, in the meantime, if anyone has any questions, please, you can type it online, and we will, if we don't have time today, we'll make sure that we will get back with our speakers to you appropriately. And lastly, we have my colleague, Gary Wong, and partner in crime, and he would give you some background on the company secretarial requirements of a main board listing.
Yeah, thanks, Debbie. I think for companies, when they come to Hong Kong for IPOs, for sure they will have to require a lot of preparations and a lot of handholdings from professional teams. For example, today's, with all these speakers, we have sponsors, we have reporting accountants, we have lawyers, which will handhold, the target companies when they come to Hong Kong for IPOs. So today in my presentation, I just wanted to briefly touch about the role of company secretary, since our client is a corporate service provider, so with most of the listed companies in Hong Kong, they are actually required to have a company secretary on board, and to be a qualified company secretary, the person has to be either a members of the Hong Kong institutions of chartered secretaries, a lawyers or barristers, or a certified public accountant. So what we see in most cases where a company with a quite substantial presence in or operations in Hong Kong, their CFO tend to be the company secretary as well. And but of course, for some listed companies which they have presence in overseas, i.e. China, Southeast Asia, or USA, they tend to outsource this role to a professional party. So this is what we see in the market, and of course, a listed company shall also appoint 2 authorized representatives who shall act at all time as the listed company principal channels of communication with the stock exchange. And these 2 authorized representatives must be either 2 directors or a director and the listed company secretary. So you actually show there's an importance of having a company secretary acting as a bridge between the exchange and also with the listed company. And from our experience, the exchange tend to contact the representative who is actually based in Hong Kong. So in this case, normally the company secretaries, because directors tend to travel, and that's why the exchange tend to not be that easy to get hold of these directors. So and next slide, please. Yeah. So so the functions of company secretaries. So the company secretary is actually here to support the board by ensuring good information flow within the board and that the board policies and procedures are followed. And the company secretary should also advise the board through the chairman and or the chief executive on governance matters. And since directors, from time to time require inductions and professional developments, the company secretary should also facilitate that. And also, company secretary should report to board chairman and or the chief executive directly. And also, all directors should have access to the advice and services of the company secretary, ensure that the board procedures and all applicable laws, rules, and regulations are followed. So, so of course, there are also a bunch of day-to-day operations, routine works that will be handled by a company secretary. But of course, I won't bore you for too much details. Next, yes. So there's actually an exemptions under Chapter 19C of Main Board Listing Rules, where company like Alibaba, NetEase, and JD.coms, they are actually exempted to have a secretaries under Rules 19C.11 of Main Board Listing Rules. However, Alibaba, which is listed in USA and Hong Kong, they have a secretary who is qualified to participate to practice law in USA and Hong Kong as well. So that's actually examples of how important it is, which to have a local company secretaries to support the board, because the listing rules actually change from time to time, especially the last 2 years. There are some substantial changes as well. So to have a professional company secretary sitting in Hong Kong, keep updating with all these change of rules, and continues to provide supports and updates with the board of directors in order for them to act fully compliant with the listing rules are actually very important. So with the time constraints, I think that's the message I would like to pass on today. So I'll pass it back to Debbie.
Thank you, Gary. I would like to thank all of our speakers, Kenneth, Ivan, Tina, Sammy, and obviously my colleague Gary. I think we're very assured to hear Kenneth talking about Hong Kong remaining the top 3 stock exchange in the world, and we're all excited in Hong Kong at least to hear about Ant Group's plan for Hong Kong, and certainly the list of secondary IPO looks to be a long list. And in particular, I note the positive impact of the new chapters on innovative company and drawing the innovative companies and tech companies to Hong Kong. And with that in mind, it's very reassuring to see or to hear about the positive impact that this hopefully will have in Hong Kong in the near future. Due to time constraint, we have gotten a lot of questions, but we will ensure that we will answer all of these fully. And my colleagues and I on the panel and I will make sure that these are answered either in a Q&A back to all the people who participated today, or we'll send out maybe a short video on this point. Thank you very much for joining us, and have a good day.